So Molina Healthcare just missed consensus on their Q2 2026 earnings report. Q2 premium revenue printed at $10.24 billion, which is down 6% year over year. GAAP EPS came in at $1.19, and adjusted EPS was just $1.51.
Right, and you really have to contextualize that $1.51 because they reported $5.48 per share in this exact same quarter last year.
Yeah.
I mean, we are looking at a massive 74% drop in adjusted net income. And the stock was incredibly volatile right after the print because of what they announced next.
Exactly, because here is the guidance update that immediately followed that massive earnings drop. Despite missing consensus and seeing profits fall off a cliff, management actually raised their full year 2026 adjusted earnings guidance by 0.25 cents.
Yeah, it's wild. They are now projecting at least $5.25 per diluted share, and they kept their top-line premium revenue guidance completely unchanged at $42 billion.
So the mission for this deep dive is to unpack this apparent contradiction. I mean, how does a company with a 74% drop in adjusted net income turn around and raise its forward-looking earnings guidance?
That's a great question.
Right. So we are going to walk you through the details here. The segment performance, the margins, the strategic exits they're orchestrating, and the very notable risks baked into the rest of the year to figure out how they are actually pulling this off.
Because management can't just, manufacture forward-looking optimism out of thin air. To see if their 2026 confidence is justified, we first have to diagnose exactly where that Q2 earnings pressure came from.
And that story really starts and ends with the consolidated medical care ratio, right?
Exactly. In Q2, Molina's consolidated MCR jumped to 92.2%. That is up from 90.4% in the same quarter last year.
Wow.
Yeah, a 180 basis point spike across a $10 billion revenue base.
Yeah.
That is a massive fundamental shift in the cost of doing business.
So if I am looking at this as a retail investor, I am doing the back of the envelope math here. A 180 basis point increase on roughly $10 billion in quarterly premium revenue. I mean, we were talking about an extra $180 million in medical costs just flying out the door in a single quarter.
Right out the door.
To use a business analogy, patient care is essentially the cost of goods sold for a health insurer, right? It's the raw materials. So if your raw materials just got hundreds of millions of dollars more expensive, you can't just wish away those rising costs.
You really can't.
So I have to push back a bit on the CEO expression confidence here. How do you defend forward earnings when the core cost of your product is spiraling like that?
Well, you defend it by aggressively attacking the costs you can actually control. The strategy here is a classic defensive crouch.
Okay, defensive crouch.
Yeah. When you drill into the SEC filings and look at their general and administrative expenses, they kept their G&A ratio incredibly tight at 6.7%. And the adjusted G&A ratio came in at 6.5%.
Which is crazy lean, operating at a 6.5% adjusted G&A ratio across a sprawling 21-state footprint. That requires freezing headcount, delaying internal tech upgrades, just squeezing every ounce of corporate overhead.
Oh, absolutely. But it is the only immediate lever management has. An insurer cannot stop a member from showing up at the emergency room.
Right.
Or needing an expensive surgery. But they do have absolute control over their own staffing and corporate real estate. They are suffocating their overhead just to absorb the blow of the medical costs.
But suffocating overhead is a survival tactic, not really a long-term growth strategy.
No, it's not. And because that consolidated 92.2% MCR is just a blended average across all their product lines, we really have to isolate the individual business segments to see why management believes the worst is behind them.
Which brings us to the segment breakdown. And if we want to understand the future of this company, we have to look at Medicaid. I mean, this is their absolute bread and butter.
Oh, 100%.
In Q2, Medicaid premium revenue was $8.04 billion, but the MCR there was highly elevated at 92.7%.
And CEO Joseph Zabretsky's commentary on this specific segment, it's really the focal point of the entire earnings report. He stated that the imbalance between Medicaid rates and medical cost trends appears to have stabilized.
Okay.
And he explicitly called 2026 the trough year for Medicaid pre-tax margins.
Okay, let's unpack the mechanics of that imbalance for a second. Because state governments set the Medicaid reimbursement rates, but they don't do it in real time. They rely on actuarial data from, 12 to 18 months ago?
Exactly, yes. There's a massive lag.
Right. So if medical inflation and hospital utilization spike today, Molina is paying the hospitals those inflated prices today. But the state is still paying Molina based on 2024 or 2025 data. It is like being locked into a fixed-price contract while the cost of your supplies is actively skyrocketing.
And that lag is the structural flaw of the managed Medicaid business model. It is entirely responsible for the margin squeeze we are seeing right now.
So by calling 2026 the trough year, management is basically signaling to investors that they believe they have hit the absolute bottom of this cycle.
That's the idea. The underlying thesis is that when the state actuaries finally review the high utilization data from this current year, they will be forced to adjust the 2027 reimbursement rate significantly upward to, match reality.
Right. They are asking you, the investor, to look past the current margin compression and underwrite the stock based on a structural correction they believe is legally bound to happen next year, which requires a lot of faith in the timeline of state
It
bureaucracies.
really does. It's a waiting game. And while they wait for those state governments to course correct the Medicaid rates, they are taking a remarkably ruthless approach to their second largest segment, which is Medicare.
Yeah, let's talk about Medicare. Revenue came in at $1.56 billion dollars, and the MCR actually beat management's internal expectations, printing at 90.7% due to lower medical cost trends.
But if we look closely at this section of the 10Q, there's a very loud detail that jumps right off the page.
The impairment charge.
Yes. Molina took a $93 million impairment charge in the first half of the year related to Medicare. A $93 million write-down is a serious hit to the balance sheet.
To me, looking at the broader strategy, this looks like a strategic amputation. Like, they are realizing they are bleeding out in a specific product line, and they're willing to pay a steep upfront penalty just to stop the margin bleed.
That is an incredibly accurate way to frame it. The amputation you were referring to is their complete exit from the traditional Medicare Advantage prescription drug product, known as MAPD.
Okay.
They have decided to abandon this market entirely by 2027. You see, traditional Medicare Advantage is a broad, highly competitive market dominated by giants who spend billions on marketing and broker commissions.
Right, all the flashy extra benefits you see on TV.
Exactly. And Molina determined they simply cannot compete there efficiently. Their core competency is managing complex, high-needs populations. So they are pivoting to focus exclusively on dual-eligible members.
Meaning they only want to insure people who qualify for both Medicare and Medicaid simultaneously. So they are retreating to their niche. But I want to understand the mechanics of that $93 million impairment charge. How does deciding to exit a product line trigger a massive accounting loss today?
Right, so when an insurer buys a way into a market or establishes a product line, they carry the value of those licenses, the brand equity, and the member relationships on their balance sheet as intangible assets.
Okay, that makes sense.
So the moment Molina management officially decided to shutter the MAPD product, accounting rules required them to admit that those specific intangible assets were no longer worth what they claimed. The $93 million impairment is just the non-cash write-down of those assets.
So they are taking the balance sheet pain right now to fundamentally alter their run rate profitability going forward, because the report noted that this MAPD product was a massive operational drag. I think it was costing them $1 per share in their 2026 guidance.
Right. By stepping away from that market, they instantly remove a $1 per share anchor from their baseline profitability heading into 2027. It destroys GAAP earnings in the short term, but it heavily fortifies those forward-looking margins.
Okay, so we have Medicaid supposedly stabilizing at the bottom of a cycle and management strategically trimming the fat in Medicare. But there is a third segment here that actively suppressed the guidance raise, acting as the primary headwind for the quarter.
Yeah, we have to talk about the ACA marketplace.
Right, the marketplace.
The marketplace segment metrics are deeply concerning. The MCR there spiked to a disastrous 88.9%. That is a massive deterioration from the 85.4% they reported a year ago.
A 350 basis point deterioration in a single year. That's brutal. And the earnings report cites a few culprits for this, right? Unfavorable prior year risk adjustments, program integrity initiatives from CMS, and an unfavorable acuity mix.
Right.
So let's translate that into operational reality. How do those three things combine to evaporate margins so quickly?
Well, the mechanism here relies on how the ACA risk pool functions. The government uses risk adjustments to balance the scales between insurers who end up with sick members and those who end up with healthy ones.
Okay, so it's a balancing act.
Exactly. If Molina's internal coding indicates their members are highly complex and sick, they receive additional premium revenue from that risk pool. However, CMS regularly conducts program integrity initiatives, which are essentially rigorous audits.
Oh, I see where this is going.
Yeah. If CMS auditors review the medical charts and determine that Molina's documentation doesn't fully justify the high-risk scores they submitted, CMS claws back that premium revenue.
So that is a retroactive hit. Molina booked that revenue expecting to keep it, and CMS is knocking on the door a year later demanding a refund because the paperwork didn't perfectly align with the clinical coding.
Exactly. That covers the prior year risk adjustments. The second blow is the unfavorable acuity mix. This simply means the members actually utilizing the ACA marketplace plans were fundamentally sicker and required far more expensive care than Molina's actuaries predicted when they priced the premiums for the year.
Which could definitely be a downstream effect of Medicaid redeterminations, right? Because when states kick millions of people off the Medicaid rolls over the last year, many of the sick individuals just migrated onto the AC marketplace to maintain their coverage.
That's a huge part of it, yes. Molina priced their plans expecting a standard distribution of healthy and sick people, and instead they got a concentrated pool of high utilization members.
And when utilization outpaces the premium you are allowed to collect by that wide of a margin, you have to take drastic action,
Yeah.
which is evident in the revenue numbers. Marketplace premium revenue plummeted to $628 million for the quarter.
Yeah, the drop-off is severe. They ended 2025 with 655,000 marketplace members, and they are projecting to end 2026 with roughly 250,000.
They are slashing their membership footprint by more than half. They project this will result in a $1 billion decrease in marketplace premiums next year.
Right, $1 billion.
And I have to admit some confusion here, or at least I want to challenge this strategy from the perspective of a growth investor. They are voluntarily giving up about $1 billion in top-line revenue just to save their margins.
Yeah.
To use an analogy, it's like a restaurant permanently closing its busy lunch service because the raw food costs are too high, even though the dining room is packed. You save money on the ingredients, sure, but you also lose all of that daily cash flow. Is shrinking your customer base by $1 billion actually a viable long-term strategy for a publicly traded company?
Well, in the managed care sector, top-line revenue is vanity, but medical margin is sanity.
Okay, I like that. Margin is sanity.
Right. Pursuing growth for the sake of growth. When the underlying MCR is rapidly approaching 89%, that actively destroys shareholder value. Every new member you add in that environment is a liability, not an asset.
That's a great point.
By deliberately pricing themselves out of unprofitable counties and shedding those 400,000 members, Molina's betting they can build a much smaller but highly profitable marketplace footprint. They are essentially shrinking the denominator to fix the ratio.
Okay, bringing this all back to the mission of our deep dive, how did they raise guidance to $5.25 per share despite the current earnings drop?
Well, management explicitly stated that if it weren't for the downward revision in their marketplace expectations, their full-year guidance would have been raised to $6.75 per share.
Wow, let's pause on that figure. The underlying performance in their other segments, combined with that aggressive G&A cost-cutting we talked about, was actually strong enough to generate a $6.75 projection. So the issues in the ACA marketplace alone drag that projection down by $1.50 per share.
Yeah, the strength of the core business is really masking the severity of the marketplace drag. And furthermore, that $5.25 guidance number is absorbing another major near-term headwind.
Oh, right, the Florida contract.
Yes. If you are modeling out the rest of the year, you have to account for a $1.50 per share loss expected specifically in the fourth quarter, tied entirely to their new Florida Medicaid contract.
Right, because Molina won a major contract to serve roughly 120,000 enrollees in Florida's Children's Medical Services Program. But launching a government contract of that scale requires an immense amount of upfront capital.
Massive capital.
It is like building a massive state-of-the-art factory. You have to pour hundreds of millions of dollars into the concrete, the machinery, and the workforce long before you ever manufacture and sell your first widget.
Exactly. Because before a single dollar of premium revenue flows in from the state of Florida on January 1st, Molina has to build out the entire provider network. They have to credential thousands of doctors, hire local care coordinators, integrate the IT systems, and, pass rigorous state readiness reviews.
It is pure cash outflow for months.
Pure outflow.
So synthesizing this entire earnings report for you, the investor that raised $5.25 guidance, is doing a massive amount of heavy lifting. It is absorbing a $1.50 hit from the Florida contract implementation. It is absorbing a $1 hit from the dying traditional Medicare product. And it is absorbing the massive margin deterioration in the ACA marketplace.
Right.
The fact that management raised guidance at all under those conditions suggests they have supreme conviction that the core Medicaid business, the real engine of the company, is fundamentally sound and primed for a rebound. Molina is navigating this high-cost environment by ruthlessly pruning unprofitable members and absorbing heavy short-term implementation costs to secure long-term contracts.
However, this entire bullish narrative hinges on one crucial assumption. drawn directly from the risk factors outlined in their 10Q filing.
Which is?
Management's entire optimistic outlook for a 2027 margin recovery relies on state governments increasing those Medicaid reimbursement rates to offset the current inflation.
Right. They need the states to pay up.
Exactly.
Oh.
But consider the macroeconomic environment. What happens if severe budget pressures on those state governments force them to withhold those increases? State budgets, unlike the federal government, are legally required to balance.
Oh, wow. Yeah, if the states look at their own balance sheets and realize they simply cannot afford to match the inflation we are seeing in medical costs, they might just refuse to play ball.
Exactly.
They might limit the rate increases to a fraction of what Molina actually needs to restore profitability. So if 2026 is supposed to be the trough year, what happens to Molina's margins if that trough turns out to be the new normal? A structural shift in how states are willing to reimburse care, I mean, that is the fundamental risk you have to underwrite if you are looking at this stock today.
Absolutely. It's the multi-billion-dollar question.
Well, we've walked you through the underlying numbers, the mechanisms of the margin squeeze, and the very real risks ahead. Make sure you follow the show for our daily earnings coverage, keeping you informed on how these corporate narratives actually align with the reality of the balance sheet.